And welcome back to a special Zoom edition of Pandemic Proofing Your Portfolio. Live, I'm Ramesh Damani on the Wizards of Dalal Street. Henry Ford used to say, when you chop your own woods, you will be warmed twice. My guest today is not only a friend of the woods, of the forests, and of the great redwood trees. He is the son of a very famous father. Despite that, he's blazed his own trail. He's a columnist. He's an author of 11 books on Wall Street. He runs almost $100 billion in assets under management, and he's a self-made billionaire. Please welcome the chairman, the executive chairman, and the co-CIO of Fisher Investments, Ken Fisher. Ken, what a treat. Welcome to our show.
Well, thank you so much for having me, Ramesh. It's an honor and a pleasure.
It's early in the morning in Seattle from where you are, and you're joining us live. Ken, simple truths sometimes evade investors, that after every bear market, there is a bull market. What is the evidence that we're in a new bull market now, Ken?
So this is a different kind of a bull market, but it is a bull market, in my opinion, for many reasons. One of them is that it is exceptionally rare when you look at the very broad global or US only market, not smaller subset markets, to recover this much of a decline and not move on to new all-time highs. So if we look at the portions of the market, for example, that did best before the bull market, before the bear market that started in February, those portions have actually continued to do best overall, both in the downturn and in the subsequent upturn. Now, that is a feature which makes this very unusual, because while we had a bear market by size, clearly, more than enough size, it's also true that normally coming out of the bottom of a bear market into a brand new bull market, smaller and value stocks tend to lead the way, bouncing hard off the bottom. That is not what has happened this time. And in that way, what I would say, and have been saying, is that this is a new bull market, but it is both a bear market and a new bull market that acts more like an oversized correction than it does a conventional bear market and bull market. And I believe that's one of the reasons that it's been fooling so many people.
Yeah, you said that it's a correction masquerading as a bear market. Having said that, is the leadership being intact? The high-tech, high-cap stocks in America suggest to you that this was a correction and not a bear market?
My view, we clearly have an economic contraction, but it's not like a normal recession. It's a different kind of a contraction because of the many governmental clampdowns on economic activity, the forced restriction, as opposed to the normal way a recession's created. So let me try to take you through that as simply as I can.
Sure.
People have a very hard time with, if you will, the faith of this, but simply the stock market has always been a leading indicator, and Ramesh, you know that. Yeah. But not everyone seems to, and not everyone seems to accept it in their bones. So the reality is that normally the stock market is pre-pricing a future that's someplace 3 to maybe 30 months into the future. Sometimes on the long end, sometimes on the short end. Knowing exactly how far it's pre-pricing is very difficult to do, but it's always pre-pricing. This time, because of the nature of the pandemic leading to unexpected forced clampdown of economic activity very rapidly, the market had to pre-price decline at the fastest rate ever in history. Off the very top of the market, we got to official bear market territory, depending on where you were, in 16 to 18 trading days. That's not quite true. There's a few places that were already there. But on a global basis, US basis, major market basis, developed nation basis, and most of the EM, most, not all, we were there in 16 to 18 days, right off the top. And
Absolutely.
that reality, the fastest ever drop off the top, is one where, by my measurement, whenever we have had market pre-pricing really fast, what it tends to do then is revert to pre-pricing far into the future. How far into the future? I really don't know, but maybe 20 months, 25 months, maybe even as far as 30 months. But it's right now looking past this economic decline. That's pretty clearly true.
Looking past the second quarter, but is it looking past also a recurrence of coronavirus, possible inflation because of the Fed stimulus? Market prices all this in pretty rapidly, and investors don't seem to understand that at the get-go.
So first, let me go back to what markets do for a living, which is to pre-price all widely known information. And nor I think anyone else, really understands what will happen with the future of this disease. People can speculate about it and have opinions, but no one really knows. In that, all of those opinions are pre-priced. And in that pre-pricing, there is a pre-pricing effect, clearly, for a second surge in the fall. The question will be, if there is a second surge, will it be much worse than people fear? That's really the way the market would react. But I think it's very possible that at this point in time, we're pre-pricing out toward the latter part of next year. The fact is that this contraction in economic activity is very unlike any recession any of us have ever lived through. And the rebuilding of it will also be unlike the recovery from a recession or depression that any of us have ever lived through. And in that, the market isn't acting, the stock market isn't acting the way it normally acts to recession. As I said earlier, normally market bottoms before the economy bottoms, start skyrocketing while the economy is still getting worse and economic data look uglier and uglier and uglier. And in that process, where it's pre-pricing an eventual return, the stocks that skyrocket the most are the small value stocks, which, oh, by the way, looks a lot like the Indian market. In that, this time, that isn't happening in the same way. It's really the growthy stocks, the mega cap, and the tech portions of the market that have led. And I think it's looking right past that and presuming that most of the small value world will end up reverting to the world that's a lot more like the world we used to live in than any of us can imagine.
So waiting for clarity, Ken, is a mug's game, right? Whether it's a correction or a bear market, because markets will never give you the chance once knowns happen.
Clarity is one of the most expensive words in the stock market. The all clear signal is really a sign that there's too much good that's already happened, and you never get that all clear signal. But for example, earlier you mentioned subsequent fears of inflation. Let me speak to that in this way. Recently I've been writing about what I call the pessimism of disbelief. And this is a concept that I last spoke about in 2010. And it happens in every early bull market, regardless. It happens because the massive plunge in prices in the back part of a bear market so frighten people that they come to have to perceive that bad things must have caused that, and they're looking for bad things. They're scared out of stocks. And in that, as the bull market begins and rises, what behavioralists call confirmation bias, or the tendency to see what we want to see what we believe we should see, causes us to over-focus on bad things and to take any potential good thing and twist it into a bad thing. And that twisting in is something that it happens in every single cycle. So if you go back, for example, to 2009 and 10, we had this same function where, regardless of what you may have thought about the very many governmental efforts to try to stimulate the economy, most of which I'm always a skeptic of. The fact is, people had to view either that they won't work, or if they work, they will cause subsequent inflation, which then the central banks will have to fight, which will unravel the good later, so don't take it seriously. If you go back to that period, of course, that inflation never occurred, and that didn't happen. And that same function you can see right now, where people are saying that the activities of central banks and the stimulus programs that governments are trying to implement, have been implementing, will keep implementing, will cause subsequent inflation. That's the morphing of a potential good into a potential bad, and is a classic sign of the pessimism of disbelief. And bull markets just blow right through the pessimism of disbelief. It's one of the most bullish things. Once you start seeing that twist, it's one of the most bullish things you can find.
Yeah, because the stimulus is generally good for the economy, good for stocks, and obviously disbelief is the, as you say, the foundation of this bull market. You've also said that whether it's in life or in markets, optimists do better than pessimists. The biggest optimist that you and I probably know is Warren Buffett, but he's been very circumspect during this crisis, sitting with $120 billion worth of cash in Berkshire. Does that bother you at least?
So let me say this two ways. First, I'm never bothered by what anybody does. It's their business what they want to do, whoever they are. And the market, in the marketplace, and I've written this for a very, very long time, in the marketplace, nobody's right all the time. If, as I've often said, often written for a long time, if you're right 70% of the time in the long term, you become a living legend. And so you better get used to being wrong a lot, because the living legend's still wrong 30% of the time, whoever you are. And that's going to apply to anybody, including Mr. Buffett. But also, I'm going to make another point. You mentioned earlier my father. Now, because of my father, when I was young, I got to meet some great investors. And the reality of great investors, in my opinion, including my father and other people, is that when they get to a certain age, they lose their edge. I'm not suggesting that Mr. Buffett's lost his edge, but I can't find a history of people his age that don't become relatively static in a crisis. They just tend to be inactive in a crisis. It's part of being post-octogenarian. With a lot of them, it's actually when you're an octogenarian. But my sense of Mr. Buffett is that's what's happening to him. He's moved into a relatively inactive phase tied to his age. Now, could I be wrong about that? Yeah. But again, I don't worry a lot about what anybody does.
Fair enough.
It's what I do that I worry about.
Yes. Go ahead.
No, it's what I do that I worry about. What somebody else does is up to them. The market is full of people colliding against each other all the time, most of whom are wrong, and some of whom are right, and nobody who's right all the time.
As you said, a 70 batting average is absolutely top of the class in this business if you do it correct. I understand that, Ken. Your father, taught us these concepts of a good stock should be held forever, long-term investing. So do you also feel that timing the market, and given what's happened right now, this V-shaped recovery, timing the market is a mug's game?
Let me take you through my thinking on that just a little bit. So my father, who was a marvelous human being, very unusual, he had what we today would call Asperger's syndrome, but all of his life, almost until his life was over, no one knew that term. Very strong in that regard, introvert, very bright, very good communicator, but poor social skills. Alone a lot. That's the way introverts that are with Asperger's are. He lived in a world optimally as a professional in 1930s, 40s, 50s, 60s, 70s, before we got to ubiquitous computer power. And something that he couldn't really deal with in that world that I think he would have dealt with if he'd been a younger man as computers evolved to become ubiquitous, is to recognize, which was true then, but it was hard to see then because of the lack of ability to do good real-time data analysis, that there's times when great companies with great style do great, and there's also times and functions where they do badly in the marketplace relative to other stocks, and another place where low quality and smaller do terribly, but they get their day in the sun also, and a time when they do great. And that's not fully predictable, but it's semi-predictable. And once you get to that, you see an extra value in trying to decipher that. And I've been working on that basically because I come from a different generation. When I was young, I did things, some of which were good, some weren't, that were aimed at trying to unlock the scarcity of data. But today, data is ubiquitous, and you can both use it for good, and it also can blow back on you. But that's a world that my father never could have really operated in, because by the time that world comes along, he's just much too old to be able to move into it. And you know what we have today, we're on a smartphone, you have more data than a mainframe computer ever could have accessed pretty much his whole life. He couldn't really deal with that. So one of the things you hear me say a lot, and now for a fairly long time, is there's a time for this kind of style, there's a time for not that kind of style. Yeah, I will tell you, if you just go back and look at the last 5 years of the MSCI India, and you compare it to the last 5 years of the Russell 2000 value, US small cap value, they look not perfectly correlated, not perfectly like mirror images of each other, but very close. And why? Because the Indian market is a small cap value market, and there's a time for that, and there's a time not for that. And that part of trying to figure those things out, something I've been working on all my life, but my father never could have. He lived in a world with a hand crank adding machine or an electronic calculator and a pencil. Different world.
Of course. But what kind of world are we entering into post-CV19? Will it be still the large cap, high-tech companies, or are there other sweet spots that we should look at after this correction?
So first, when you say after the correction, I believe we already are after the correction. If you look, for example, at the NASDAQ, it's almost to new all-time highs.
True.
If you just take the world and break it down into what was doing well before all of the pandemic and the February peak in the market, and then look at what's been doing well since, there's only a few variations. And the fact is, what's been leading the market is mostly the same stuff. Could that change? Yes, it could. Will it change because of what's been going on with the pandemic and the economic constrictions associated with that? I don't think so. And the reason that I don't think so is that this is not the kind of recession that we've normally had. In the traditional kind of recession, or even the Great Depression of the 1930s around the world, the part that did best coming off the bottom right from the beginning was small cap value, low quality stocks that had been overkilled in the downturn. In this world, the downturn was full-size bear market, 35%, but coming off the bottom, small value continued to lag. And it's had weeks and sometimes 10 days where it spurted, but overall continued to lag. And in that, I think this market's acted more like a correction, so we should treat it that way. And I think it's the next cycle, which I don't think is necessarily terribly far into the future, maybe 3-4 years, where you see small value lead. But I think we're lead overall and for a significant period of time and for a significant amount of money. But I could be wrong, but I think we're premature for that.
Ken, considering you spoke about India mirroring the Russell 2000, clearly you follow India a little bit. You have any thoughts on India as an emerging market? Any Indian companies you've looked at? You run $100 billion, so you have a lot of money to invest.
Well, I'm not meaning to be corrective to you, but we actually run $120 billion. But
okay, great.
Who's counting $20 billion, right?
Yes.
The reality is, or at least my opinion is, that emerging markets is a misnomer in this way. If you look at the largest emerging markets, the four largest together make up about almost exactly 2/3 of the MSCI emerging markets index in money value. And in that, there's relatively little in common between them. If you look at the totality of the emerging markets countries, excluding frontier markets, separate thing. If you look at the entirety of emerging markets, you can say that Brazil, a much smaller market than India, has a fair amount in common with Mexico, which again is smaller still, but neither one of those have all that much in common with India. India, one of the bigger ones, doesn't have that much in common with Taiwan, doesn't have that much in common in a lot of ways if you look at its sectoral makeup or the nature of market cap with China. And so they're really all different things. And to lump them together as if they were all one is to presume that everybody in a so-called family is actually all the same, which is, I think, inappropriate, incorrect. The Chinese market should act different than the Indian market. The Indian market should be considered different than the so-called emerging market Hispanic country markets. You take Saudi Arabia, it's a marvelous place. I like Saudi Arabia a lot, but it's very different. And the fundamental feature of India at one level can be described as the very largest stocks in India are tiny compared to the dollar-weighted average of the global market. The dollar-weighted average of the global market is in the $188 billion range. The very biggest ones pull the average up so high compared to the very, very, very many small ones that it makes that market act like a $180 billion cap market, and the very largest stocks in India are, 4 or 5% of that in size. So it's a small cap market compared to the world, and it has to be thought of in that way. And there's a time for that, and there's a time not for that. And when you look at the biggest stocks in India, they don't really fit in, forgetting about size, to what's been the sweet spot of the market over the last couple of years or over the last few months, which is
mega large cap.
Not mega cap, yes, but not just mega cap, also growthy and particularly techy. If you look at the Indian tech companies, they tend to be software services on the larger side, as opposed to the kinds of things that are been dominating in this time period. So there's nothing wrong with any of those companies. They're great companies. I'm not negative on India as a place at a time, but it's just not the right time. And if you're an Indian investor, and I would say this, if you were an investor in any other country, you should always think global, because it's a big world and all of the pieces fit together like a macro kind of a round jigsaw puzzle. And yet, there's a time and a place where some of the pieces of that puzzle routinely do better and some of the pieces of the puzzle do worse. And everybody should be able to get in their head that that's true. And those fall down into categories like bigger stocks, smaller stocks, growthier, more value, and certain sectors. And it's important to keep all of that in your mind, as well as thinking about the individual companies, which may be fine within their size and style and sector, but it just may not be the right time for those.
Yeah, I get that. It's perhaps not the right time for the stocks, but the time of the US elections drawing upon us, Indian investors are very keen to understand Trump versus Biden, Does it make a difference? And how are you calling this race in the few minutes we have left to wind up the show?
Well, I regret that we only have a few minutes left because it's fun speaking with you, and I hope you invite me back sometime.
We'll absolutely invite you back.
Terribly, but
not at all.
But let me just make these statements about the way the market works relative to presidential elections. In an election year where we elect, and there's a long history of this, and there's almost no inconsistency here. In an American election, in a year where we elect a Democrat, the election year tends to be below average and the inaugural year tends to be above average. Exactly the reverse happens in a year where we elect a Republican. The election year tends to be above average and the inaugural year tends to be below average. And the reason for that is because people generally believe that the Republican is more pro-business, more pro-free market, more anti-regulatory. They tend to think of the Democrat as sort of the reverse of that, more anti-business, and those pre-pricings are built into the election year. And because the market pre-prices, when we elect the Republican, the market's hopeful about him, and the market pre-prices that. When we elect a Democrat, the market's more fearful of a negative effect. When you get to the inaugural year, that flip-flops and reverses because presidents can't do as much in the American system as people hope or fear. A lot of people hope for the guy that wins, a lot of people fear the person that wins, but we have a system in America that was created by the Founding Fathers to slow down the president and the president's ability to get much done. So if you're hopeful about the president, you're going to get disappointed. If you're hopeful about the president, in the year you get pleased.
It's, as you say always, Ken, pricing in the market. You know, to end the show, I got a quote from you from naturalist John Muir. He said, in every walk with nature, one receives more than one seeks. That's true of nature. That's true of our conversation. Thank you so much for joining us on Wizards. And we'll take you up. We'll have you again on another show, a longer show, hopefully, of the Wizards of Dalal Street. Thank you so much, Ken Fisher, for joining us from all the way from Washington on the Wizards of Dalal Street tonight.
Thank you for having me.